All right. Well, good morning, everyone. I'm James Spindler. I'm a professor here at the law school and the business school. Welcome to our panel on Reg BI and technology, where we will be discussing the promise and perils that technological solutions such as robo-advising and automated disclosure can present in the broker-dealer space as Reg BI comes online. So to help us explore those issues today, we have a very distinguished panel. Starting from your right to left, we have Ken Joseph, who is a managing partner at Duff and Phelps, where he leads the dispute consulting practice, as well as the blockchain and cryptocurrency task force. Prior to that, Ken served in the SEC in various capacities, including as an inaugural supervisor in the Division of Enforcement's Asset Management Unit, and as a senior officer in the Investment Advisor Investment Company Program in the Office of Compliance and Examinations. He holds a JD from UNC, another lawyer, great, and an MBA from St. John's. To his right, your left, we have Harvey Westbrook, who joins us from Deloitte's Transactions and Business Analytics practice, where, among other things, he and they evaluate third-party technologies and compliance systems. Before joining Deloitte, Harvey served as Assistant Director in the SEC's Office of Quantitative Research and the Office of the Buy-Side Division of Risk, Strategy, and Financial Innovation, and also as a financial economist. He holds a PhD in economics from the University of Illinois. And then last but not least, to my left, we have Aaron Gubin, who is the head of product at SigFig, a technology-driven investment advisor firm. Prior to that, Aaron earned his PhD in finance from the University of Florida and spent some time in academia teaching investment management to MBAs and undergrads. Okay, so I think perhaps a good place to start is just sort of with the general question of to what extent will technology solve all our problems and make all this go away, and maybe more particularly, what exactly do we think these technological solutions are going to look like? So maybe Harvey, would you like to start us off?
Sure, I can start us off with that. Is technology going to solve all our problems? No. However, technology is going to facilitate, I think, a lot of the assessments of the obligations that are outlined in Reg BI. And it's going to do so, allow a lot more flexibility and many deeper insights as those technologies and that additional data gets captured within the infrastructure. And those infrastructures are going to have to change. Right? We know that, again, in the broker-dealer space, a lot of that information is collected to accommodate a suitability standard. How is that infrastructure and the data collections and the information required to really govern and comply with the additional obligations built into Reg BI, how are those investments going to have to change? And I think right now that's very much in flux, as we've heard, as the thresholds get determined, as the principles get translated into actual implementations. But technology is really going to be the way to really get from where we are today to a place where compliance with Reg BI is consistent across the board.
So we're not there yet, but there's some promising looking.
It's not June yet, but yes, that technology I think really is going to provide a lot of promising ways to construct a path out and to generate those best faith efforts that we heard yesterday with the staff of the SEC mentioning along the way.
I see technology as having a role on at least two levels. One is internal to the firm in the cataloging of conflicts and fees, the assessing of all of those internal procedures that may lead to issues down the road, as well as looking at data privacy issues, data security issues, and the like. I also see technology having a role on the product selection and to the extent there is a monitoring obligation in monitoring investment performance and so on, part of meeting the duty of care obligation under Reg BI. There are some solutions in place currently. None of them are perfect, and I think it's an area where it's ripe for future development as firms continue along this path of automating their compliance obligations.
Aaron, would you care to comment?
Yeah, I mean, I think there are a lot of individual component parts that are available in the space, and I think one of the challenges that will exist is how do you connect all of those different parts together. For example, you might consider having Form CRS as part of a DocuSign envelope, so an electronically signed form with a whole bunch of other disclosure statements, et cetera, that go along with that package, that envelope. But then being able to tie that back to the particular client when they signed it, validating that you still retain that record. I think a lot of those pieces need to be figured out in this particular space. And I think a number of different tech firms have tried to do it for their particular solutions, and the space of broker-dealers, in my view, is quite a bit more diverse. And so the challenges there of putting together technological solutions that will address that diversity, I think, still remains.
Well, let's talk for a second about the attempts that have been made so far to start to address these problems, right? So have we seen broker-dealers starting to ramp up technology for these compliance purposes already? Have we seen have we seen yet a third party that's coming up with a package solution that you can plug and play and forget about all our Reg BI problems?
I've not seen the one where you can forget about all your problems. We have seen firms start down a path in thinking about how, again, they take their systems that are in place to really show compliance with a suitability standard, and what are those changes that need to be baked in order for them to actually be able to tie back compliance to the specific obligation structure that's outlined by BI. And so from what I've seen, those steps are starting down those paths. I think different firms are in different places there. But I want to highlight a couple of the pieces that they're going to have to resolve along the way. In particular, there's the disclosure obligation that's there and presenting that information out to customers. But there's also the requirement to actually demonstrate that you've satisfied an obligation of care, which is among the factors that are contained and recommended within Reg BI, can be a pretty sophisticated data collection process and a comparison process if you're actually demonstrating and providing evidence that you've complied for a duty of care for a particular product in a particular investment class, right? And so there's strategies and other longer-term investments that have to be made as firms build out this infrastructure along the way. And as Aaron's mentioning, this is pulling in lots of other information to actually set up a robust compliance program as well behind this. And I think there's been a lot of discussion around the importance of disclosure to the investors directly. I think the other part of this that's going to be a potentially even bigger investment is really setting up that robust compliance regime behind to really do effective, really efficient comparisons that have to be done really quickly if you're looking at all the recommendations that get made across your financial advisor space, right? I mean, that's, again, technology allows you to do that, but it's got to be fast, it's got to be very efficient, and within the organization, you have to have all the roles, responsibilities, staffing required to support that and then report that out.
I'm going to caution here on the over-reliance on technology. I think this is an old debate where, as we rely more and more on the machines and the code, we sometimes forget the sort of common sense, human judgment that that is very often involved in assessing whether something is an issue or not. I'm not aware of the code or the AI that could literally replace that human judgment. So I just want to make sure that as we try to get more efficient and automate, that compliance programs everywhere are investing in the training and the human capital that's necessary in order to make all of this work more efficiently.
I cannot understate that statement. My view of technology and the software development team, both from inception of concept to execution of that code, there are human beings involved. And to the extent that everyone has to understand how the different component parts work, what the compliance rules are, in our firm, compliance is an integral part from the beginning of like product design, and we work with our compliance team to validate that the work that we do meets all the regulatory requirements. And it goes back to thinking through like a quality testing program, where we may think through a lot of different edge cases and error handling and exceptions handling, and how does that work, and how do we track all that information, and how do we enable compliance to provide correct oversight? Do they get the right level of insight into what it is we do?
So just to be a little more particular here, maybe we could talk a little bit about what exactly this technology looks like and sort of the various, or what it will look like in the various components of Reg BI that we're going to have to deal with, right? And so as we've heard in the previous panels, right, there's a few different elements of this that you can sort of break out. One of these would be sort of as part of the diligence requirement, getting to know your customer, make sure you know who you're dealing with, and providing correct advice. Another aspect of this then would be the requisite disclosures that we have to make. We heard a lot last panel about conflicts and those sorts of problems, and do you have to, the level of disclosure that's required is something of a little bit up in the air, sort of as a matter of law currently, I think. But so what will that look like technologically? And then sort of where the rubber hits the road is making the actual investment recommendations, putting the client in a particular mix of securities, particular portfolio, tax advising, things like that. So could we comment on what those things are going to look like? Let's start with whatever you like. How about the know your customer aspect of this? Are there issues or problems with that?
I think that there's going to be a range of technological solutions to that. I mean, I think at the thing that technology is especially good at is the work that human beings don't like to do, the drudgery, the record keeping, the oversight and monitoring. So to the extent that technology is going to be particularly good at recording that kind of information, I think that's something that we are much more likely to see fairly common. In terms of how do you get to know your customer, how do you provide investment recommendations, I think that a lot of different firms are going to handle that very differently. There are firms out there that will work with an investment committee to try and outline what they think the right algorithm will look like to collect information and make judgment calls about what that client is best suited for and what investment recommendations are the right in the client's best interest. And then we'll be able to store that information. We'll be able to go back, review it. Does that investment recommendation make sense in the aggregate and in the specific? But I think that there's going to be a wide range of how different firms handle that.
I think with regards to know your customer, know your client type obligations, to the extent anyone is going to be relying on technology as the sole or the primary tool for assessing customer suitability, for example, it's a garbage in, garbage out type analysis. And I question again that there has to be systems and processes built in order to assess the quality of the information that you may be collecting from the person on the other end before moving to those later stages. So any code has to be able to error check and to validate in order for it to be effective as a foundation for making the other judgment calls that are required under Reg BI.
So just to follow up on that point, I think in collecting information from customers and using the FA to actually collect that information, how is that customer information overlaid with the profiles of other customer informations there in a way that's going to be comparable down the road as one piece, and layers into a larger compliance function so that the information that's provided there in the recommendation, and then ultimately how the interaction between the FA and the customer gets assessed from a compliance perspective relative to all that other information that's out there, right? So they made a recommendation that might be slightly more expensive. However, that context, and that's, I think, is where Ken's going, that context required to demonstrate that, well, for this particular customer, the FA actually did satisfy that requirement of care based on these other factors, and being able to have that infrastructure in place and the organization functioning in a mature way so that that process happens really efficiently and ultimately gets compared to all the other features that are comparable, whatever that means, right? When compliance folks actually come knocking on the door and the regulator asks questions about, why are these particular transactions treated in this particular way? And that's a lot of infrastructure on the technology side. That's a lot of training. That's a lot of organizational maturity. And that's another thing we haven't really talked about here. But, if I'm no longer, I'm speaking for Harvey and no one else, but if I'm knocking on the door and I'm that compliance guy, I'm gonna ask for, what are all your exceptions? And how did you satisfy those exceptions in a mature way really quickly, right? And if they can't answer those questions and answer that in a way that's informed by the data and their larger data model, I think they're gonna have challenges in actually articulating those thresholds organizationally that they put in place to show this is what it means for us to satisfy the duty of care, the care obligation in this particular way for this particular factor. And that's, I'm talking a lot about lots of different infrastructure, but it's not just the technology, it's an organizational change that would have to happen to support that.
Sure, certainly the interface with the technology is something that we have to worry about too. Picking up on a point that Ken mentioned, garbage in, garbage out. Presumably with technology, we're going to be automating these processes to some extent. We're more reliant upon in many cases, the retail investor here to accurately interface with the platform that's provided to provide correct information. But when you're dealing with retail investors, you're often dealing with a particularly naive bunch of folks that may not know a stock from a bond and may not understand the concept of risk. How much can you automate that? Is that something that we're going to maybe relying on our experience in the investment advisor context where we already have these platforms already? Is that something that we've successfully dealt with?
I think in my firm's experience, there are always going to be challenges in educating our clients on what they are investing in. I think we generally try to take a fairly straightforward, simple language approach to what it is we do, specifically with respect to the kinds of investments, largely ETFs, index funds, et cetera. We try and describe what the software, what the service does. But I am certainly of the belief that there are lots of products available to clients, and it is very difficult for them to understand what the difference between a stock and a mutual fund is. We definitely observe that people struggle to understand what the difference is, and there's obviously differences. And yet the technology is there to provide them with information all the time. It's on 24/7. The technology provides a good, consistent advice, and I think that's something that's pretty important when you think about the information that a client gets and the recommendations that a client gets today would be the same information that recommendations that they might get tomorrow, or if they had talked to a different advisor. The technology basically provides good guidance for the advice to be consistent given the same set of inputs.
I think there's a tension between the broker-dealers or the advisor's obligation to provide full and fair disclosure so that a customer or client can make informed decisions. And some who may view the obligation to be you need to crawl into the client or customer's head and make sure that they understand. I don't see it, that latter point, as being an obligation of the advisor or the broker-dealer. I think it's a reasonableness standard. I think you need to certainly make full and fair disclosure of all material facts. And then at some point, you have to, absent any indications to the otherwise, to the contrary, you have to trust that the person on the other end is indeed understanding what they're reading and are making an informed decision as part of the process. I don't believe that there's any obligation to make sure that they have read every word or understood every concept in a particular investment decision.
So Ken, you brought up the topic of disclosure and making full and informed decisions, fair and informed decisions. Is this a case where technology is going to be particularly useful? As we saw in the last panel, it seems like the conventional wisdom is that you can satisfy your disclosure obligation with a long boilerplate form ADV that contains every possible bad contingency that could ever occur. Is this a great opportunity for technology that not only do they have the ability to look up the ADV on their own, but now we can email them a copy of it every single time we give a recommendation or do a trade?
Everybody wants more spam. Yeah, I mean, I think, look, to the earlier point, garbage in, garbage out, right? Disclosures can be pretty dull and nobody wants to read them.
Or maybe putting it more positively, does technology allow us an opportunity to make maybe more reasonable disclosures?
Sure. I mean, I think the thing that I love about technology is the idea that you can fairly easily assign some logic that will send the right disclosures for the right purpose. So you get a particular kind of account that needs to get open that has a particular set of disclosures. Easy enough to say, here's the right disclosure for this account. You don't need a set of disclosures that covers all accounts. I think there are opportunities to make the disclosure set much more applicable for the particular use case of that client's needs. At the same time, we can also do a better job of writing better disclosures that people can understand.
Harvey, can you comment on this?
I guess, the thing that how far can you expect disclosure to take you, right? Because clients are going and are buying financial advice because they want something from that advisor, broker, whomever, right? And there's a level of professionalism that is expected on the other side. We can put in that information and provide it to them, but how does that inform their decision? I think one of the things that BI, from my perspective, will do to improve this is potentially push to make more consistent the communications process between the financial advisor and the brokerage community, and have additional layers of oversight into how that communication happens. Right? It can't just happen outside of it. When you do this, the expectation is that there are standards around that communication exchange of information, and the ability to then track what value and what services come out of that communication.
So when you talk about oversight of these communications, which presumably will be somewhat automated, is this also automated oversight as well, algorithmic oversight of the?
Could be collecting that data, actually doing things and making sure that compliance is informed by the data that they actually see. Do I really understand that this advisor communicates in a way that's different from the other advisors with those customers? What do I see in terms of the products that they're getting, right? And how do we know that for those recommendations? I mean, maybe that advisor is actually dealing with a special set of customers who have special needs and is satisfying their reasonable consideration there. Fine. In a robust organization, you can verify that and evidence it in a couple different ways. I don't know that that's done now with that suitability standard, right? There's the requirement to actually collect, process, and put that other compliance structure around that communication is not necessarily there in a way that it will be, right, with Reg BI.
Understanding like the testing and oversight, how will you conduct those tests? What are you looking for? is part of how you set up, how at least a tech firm should set up the product itself. Can we make it fairly straightforward for the compliance team to pull a report that says, did clients in situation A receive disclosure A and clients in situation B get disclosure B? Presumably with good input in the product development cycle from compliance, we can understand how to build into the software good compliance aids.
So can I ask about how this sort of compliance or product auditing, I guess I shouldn't use the term audit, this product compliance process works? Is that essentially what happens? Is we start with test clients and see, do they get the right recommendations based on some rubric at the end of the day, or is there something else involved in this, making sure that our tech works?
Yeah, I mean, I'm happy to describe what happens for us. We sit down both with our compliance team and engineers to think through different use cases. As we build that software in a development environment, not in a production environment, we can then sort of run hundreds, thousands of different kinds of scenarios against the software to validate that the right disclosures and the right conditions get set up. That often leads to error cases that we hadn't necessarily anticipated, and we need to make sure that we properly update the software and work with the compliance team to make sure that we've correctly sent the right disclosures in the right places. We do a daily test of our software in production, and then as we have the compliance team come through and they do their regular frequent checks, depends on the different kinds of things, but it could be weekly, monthly, quarterly, or annually. The team can come through and do some analysis. And then we've got friends at big four accounting firms that will come through and validate that the software does what we think it's supposed to do as well.
Harvey, would you care to comment on your...
In some of the clients that we work with, when they hire firms like Aaron's to embed and white label their products, they will hire firms like mine to come in to see not only are the requirements that they presented to these firms accurately reflected in their infrastructure, right? But also to see if under certain stress tests and potentially edge cases, do those limitations or constraints that are embedded work as is expected, right? And that's important for these clients because if they're white labeling some of this infrastructure, they still have that fiduciary responsibility, right? And so from a regulatory perspective, they are going out, bringing in this technology, satisfying their fiduciary responsibility, and you could likely see other types of approaches in the broker-dealer space as they start to think about how those complicated information collection and aggregation needs to happen in order to really comply with Reg BI going forward in a complicated way.
I want to underscore something a little bit different but related, and that is something that you said, which is the involvement of compliance in the innovation process pretty much from day one, but in the technologists, the product specialists, if you will, as well as compliance as part of an integrated team, so that compliance focus is built in from day one and is not reactionary at some point down the road. There are additional factors, though, I think, with any technology solution here, which is that auditability function as well as the record-keeping function. And record-keeping functions, I'm particularly thinking about changes to code and version control and all those good controls that one ought to have so that we can understand when changes were made, whether those changes were tested before being put into production, and that we're modeling out the potential impact that it may have on our ability to meet the fiduciary duty obligations under the rule. The other part of it that I want to highlight as well is that technology here can be both a friend and a foe, because as you collect data within the firm and you analyze data, within the firm, remember that the regulators down the road somewhere, maybe not immediately, on Form CRS and Reg BI, but the regulators somewhere down the road also have the ability to analyze not just your data, but across industry and across various firms. So know your data if you're going to take that obligation to automate and do the analysis. You can't just let it sit there. You have to figure out whether there are potential issues, either actual or potential violations of your policies and procedures or of the rules that may be implicated, and error correct as quickly as possible, and disclose if such disclosure is required.
So, Ken, bringing up some of these potential legal risks that may arise already in the investment advisor space, could you comment on how we might see more or different risks arising in the broker-dealer context? So, for instance, broker-dealers obviously run on commissions. How do we program our bot to maximize trading commissions while still abiding by regulation best interests, or something like the you mentioned account monitoring, or the fact that we're collecting this data now. Are we obligated to act on this all the time? Is there a distinct period in which we're making recommendations and in which we're not? Since the technology never sleeps, how does that change things?
Yeah. So if I had the answer to all of those questions, I'd be calling you from my boat right now, but it's not happening. So here's what. Look, there's a long line of cases coming out of the investment advisor world with regards to this fiduciary duty obligation. Technology does not ultimately change those obligations. It could perhaps make it easier to fulfill those obligations, but it doesn't change the baseline obligation there. I suspect that, especially in the early days of Reg BI and Form CRS in the broker-dealer world, that the whole mapping of conflicts, the mitigation of conflicts, the identification of all of the fee and compensation arrangements is probably going to be the areas where you're likely to have the most pitfalls. For some, on the broker-dealer side, it's a relatively new concept that I think folks have to get used to, that whole conflict analysis that, as I mentioned, has been a long history on the investment advisor side, now being brought over into the broker-dealer world. It's crucial that broker-dealers get that analysis correct. Conflicts come in many, many different forms, and to the extent the infrastructure is not there at the broker-dealer to identify and map those conflicts, mitigate and disclose where such is appropriate, I anticipate a period of adjustment that could possibly have an increased risk of litigation, investigations, examinations, and so on.
I think following up on Ken's point, I think the requirement to actually think through those conflicts as they go, one can expect regulators are going to have those use cases that they see because they look across the entire industry and are understanding the things within these individual firms that maybe, again, your particular firm, if you're just looking at the conflicts that you know and that you've been looking at a while ago, that may not be sufficient. That's got to be a dynamic process, and it's got to be a dynamic process that goes through with mitigation efforts along the way, right? And I think, again, in the IA space, at least from a disclosure perspective, they're familiar with that approach. That's something that Reg BI is bringing to the fore, and that's going to require that infrastructure be there and that staff are thinking those pieces through, and that use case portfolio grows and evolves with that business and what you're seeing.
Well, so just to drill down on that a little bit more, I mean, what is an algorithm going to look like or maybe this won't be handled at the actual algorithm level, but that's going to trade off, say, 100 basis points of portfolio performance for 50 basis points of brokerage fees. I mean, is that something that you can, because presumably that's implicitly what's happening in the current brokerage model now, where we have a shelf of set brokerage products that have preferred fees. Is that's how the brokerages make money and continue to exist? Is that going to be something that we're going to build right into the algorithm, or is that going to be set on some other level?
So how do you assess the marginal trade-off of the factors that are outlined in that care obligation, right? So that, okay, my aggregate fees are slightly higher, but I have a additional qualitative information based on that particular transaction that gets me over that hump. How do I get that through? Does your compliance function, is it robust enough to red flag that? 1. 2, if that exception gets through, have you captured why that exception gets through? And are all those stages then compared periodically across your entire transaction space, right? All that has to be done, and done quickly and efficiently. Technology is the way to start that process. Yeah. But I'm intentionally saying there are different steps and roles and responsibility with separation of duties and other pieces involved in order to get that oversight in place and working effectively, right? And again, that's just tied into your question about the 100 basis point difference. Is it that difference, or is it the fact that the context required to show that you've met a reasonable standard, right, has to be put in place and comparable to everything else that goes on in your organization?
I think if we take away nothing from this discussion, we ought to at least leave with the notion that technology is not going to solve all of the issues here. We said it at the very beginning, and it's a good point to reiterate it now. Part of the problem is that we're in a principles-based regime, and all of the code and all of the AI and so on, given the lack of definition for some of the base concepts here, it makes having a total technology solution pretty much impossible. So the other takeaway, I think, has to be that it's an aid, it's a tool, the technology solutions, but it can't be the complete answer because you do need that additional level of judgment, if you will, that's going to be required to make those kind of assessments as to whether a higher costing investment, for example, is indeed in the best interest of the customer or client.
Aaron, would you care to comment? Because it seems like in the current investment advisor space, a lot of the robo-advising is used to provide cheaper fee, lower fee, diversified, tax advantageous planning, right? That doesn't seem like it's going to really port over to the full service brokerage model.
I think it'll be different. At the end of the day, most of these algorithms aren't writing themselves, right? The machines aren't figuring it out yet. Human beings have to figure out, how do we take the logic, how do we take the judgment call and program that into a computer such that the machines can then follow the set of logic. They've got to make those trade-offs. So in the investment advisory space, there are investment committees that are trying to make those trade-offs, trying to figure out how to set what those trade-offs will look like, how do we make the judgment calls about clients' responses to our risk tolerance questionnaires, how do we assign them correctly, where do we make those trade-offs, and program those into the algorithm. So I think at the end of the day, to Harvey and Ken's points, technology is just a tool. It is a mechanism by which we can much more efficiently, scalably apply the same set of rules and the context by which we're ingesting information about a client and then deciding what recommendations to give.
Can we talk for a second about what happens when things go wrong? So what sort of pitfalls are there that are possible in the broker-dealer space going forward? What sort of, maybe a good place to start would be, what problems, if any, have we seen arise in implementing technological solutions in the investment advisor space where they're already relatively built out? So what can we learn from the experience so far?
Try?
I'll give it a shot. I think one of the challenges is really the big one. There's a lot of moving parts here, right? Where does one start? It's not going to be fixed right away. And as we've said, even if you port it over the perfect technology that works tomorrow, you still have a large organization that has to really set up a compliance regime that's going to require folks and responsibilities and implementations within that organization to work. That's going to take time. It's going to take prioritization within these organizations to get there. I think as well, it's likely going to require some additional guidance from regulators in terms of where some of these lines are going to be drawn as implementations start to happen. And there will be responses along the way as we go through there.
So do we need more guidance? Is that the main thing?
I don't think more guidance, but I think there's going to be specific implementation challenges, of the ones that we've been throwing out. Even if the technology works really, really well, it's a principle-based rule, and where are those lines? And good faith efforts are going to happen. Lots of firms are going to choose what paths to take, and there are trade-offs associated with those paths. And I think if to the extent that there's going to be regulatory guidance, there's going to be guidance with that context in bear, right? So, okay, this is where we are now, or as an industry, where do we need to go next, and where might those lines be drawn? I mean, we get the types of questions now. It's if a broker gives a recommendation, what's their information responsibility based on what the client has outside of their? That's someone going to work every day. That's a real issue, and there's no clean answer there. Things like that, those types of issues, as you start to get into the implementation details, are going to have to come to the fore and be sketched out. I think that's one of the larger challenges that's out there, is that there's going to be, the industry is going to have to move along the way in order to implement these other pieces that are there in terms of the obligation space.
The real world's messy. Like technology handles the happy paths real well. If the client goes from step A through step B through step C, easy peasy, easy to track, easy to handle, easy to record, etc. Unfortunately, the real world's a messy place, and the specific instances of a client may not particularly hew to the setup of a technological system. So in my experience, one of the key challenges of setting up a technological environment is graceful exceptions handling. And how do you deal with that? How do you record? How do you give good, consistent advice? How do you make sure that the compliance team understands sort of what those exceptions will look like to provide better disclosures, to provide better advice? Is
this a client refusing a recommendation and shooting off on their own, or what do you mean by exceptions in this context? Yeah,
I mean, I think again, like the real world can be messy, right? So like you could have clients with particular tax situations that is reasonably unique to that particular client. You could have them declining particular aspects of a recommendation. They want to go off on their own and do. In my case, for example, a client might choose. They don't like the model portfolio that we may set up for them, and we have to be okay with saying, "You're not for us." I mean, that's hard. And you've got to sort of figure out what is the right way to gracefully handle that exception.
And how do you handle that exception?
In many cases, our firm has both this hybrid. It started out as a sort of direct to retail technological thing, and over time we've sort of observed how human beings engage better with human beings. Like there's that relationship aspect of it. Along with a technological sort of platform to provide advice at scale. And so in many cases, the software can flag that a client is For example, you can move the risk tolerance slider. And if you do this frequently, it's effectively the same thing as day trading. And so our software will flag that client, and our financial advisor team can reach out to that client and say, hey, this is not the program for you. If that's the thing that you're after, there are other services that may be better for you. What we provide is a slightly different service. So in some instances, we will pick up the phone and have that conversation with them.
I think this would be a good time to open up the floor for questions if anybody has them. I'm going to keep on our discussion here, but in the meantime, if you want to signal for the microphone, please feel free. So I think anybody in the sector knows that broker-dealers have already rolled out to some extent some use of technology in their platforms. It's cheap to do. It's relatively easy. You can analyze a portfolio. You can provide some tax tracking ability. One thing that I've noticed, sort of anecdotally, using my own online brokerages, and I won't name names, but is that they're sometimes wrong. So it gives me tax basis that's incorrect. It hasn't tracked things correctly, or it's analyzing my risk of my portfolio based only on a subset of the portfolio and not actually the whole thing that's even at that brokerage. And it seems to me that regulation best interest probably creates some problems for that type of technological. I mean, that would be a recommendation. It's telling me to go riskier. It's telling me that my tax basis is one thing when it's another. I think that's a recommendation. I think that's advice. Ken, maybe this would be a good one to start with you. Are we going to see maybe a rollback of what broker-dealers are using in terms of technology if they're not willing to make the full investment to really bring it up to speed and make it tip-top and up to the Reg BI standard?
Pass? No. I'm sorry. I had a flashback to business school, and the professor asked tough questions. You're able to say pass at least once. So clearly didn't work in this environment. So again, we made the point earlier with regards to technology not being able to solve every problem that may arise in the whole investment relationship process. But I do think that broker-dealers or investment advisors who begin on that path of using technology certainly should not forget their obligations, the baseline obligations here. Best interest, fiduciary duty, whatever you think of suitability, if it still survives, who knows. But there are basic obligations that technology isn't going to be able to fully replace. So if you do take that step, you still have an obligation to get it right, make all reasonable steps to do so. If something is wrong, certainly whether that's on the product selection side or the product monitoring side or the know your customer side, you have a responsibility to act promptly to correct and perhaps even to disclose under certain circumstances. I don't know if that answers your question.
Well, another way of putting it is, is this going to be a field day for the lawyers to some extent?
Well, I hope so, no. No, it's the Lawyers Full Employment Act is another way of perhaps looking at it. Look, we live in a litigious society, and when things go wrong, that's definitely a risk. It's definitely a possibility. But I think under almost every circumstances, the protective steps and the diligence that you take up front, the escalation procedures and the disclosures and corrective actions on the back end go a long way in softening the ultimate blow that you may have to deal with.
And James, I would actually say that might be an opportunity for them to revisit their platforms to make sure that they're sharing their data model is consistent across all their accounts, account types, their full set of offerings, and even multiple sides of the house. I have no idea who you're talking about, but if they're a dual registrant, then is that information appropriately collected, reported back to you? Because at some point, that's the type of thing that's they're going to be asked questions about, right?
It sounds like a field day for the lawyers and the consultants.
Yay.
All good. But I do think, though, I mean, the other side as well is also the opportunity for you to get, more consistent investment advice that actually reflects your full investment profile, right? And pushes that notion forward to really enforce consistency of financial planning, which is the other thing that's like really what you're buying, but maybe not what's being delivered given all the other stuff and the regulatory structure, infrastructure, all these other pieces that are there, right?
Yeah.
So,
look, I realize there's a huge debate going on now with regards to the usefulness of Form CRS and Reg BI and the like. The fact of the matter is the rule is here, and quite frankly, I think it creates an opportunity because at base, investors, it's a trust and confidence relationship, right? And to the extent that Reg BI increases transparency, simplifies the analysis of, and allows people to be able to compare across investment advisors and broker-dealers, I think that's ultimately, in the long run, a good thing. Will there be bumps in the short term? Absolutely. Are there going to be retraining and cultural changes and technology solutions that may have to be put in place? Absolutely. But people are going to keep investing. The economy is going to keep growing. The sun will come up tomorrow, and we'll get through this. I think just the fact that many people have taken the time, like attending conferences like this one, to understand their obligations is actually a good thing. The pause to assess the fees and the conflicts and the disclosure obligations and so on, ultimately a good thing for the industry, in my view.
So I think we're at about time for some concluding thoughts and maybe some recommendations for best practices going forward. So, if we take anything from this discussion of technology and what the promises and the risks are, is there anything that we can say about as we start to build out in the broker-dealer space? And maybe Aaron, would you like to?
Sure. I mean, I think I'll just sort of echo what we have said in the last hour, is this idea that technology is just a tool, that the human beings that are making the assessments of what can be correctly managed by technology is important. Having a good change management process is particularly valuable, working with compliance from the get-go on how the technology will manage the delivery of the advice, the ongoing monitoring of that advice, I think is pretty important. Having things like dual code review, et cetera, to mitigate errors in the actual software development, et cetera. So there's like plenty of good best practices that are already used in technology in the investment advisor space. And so it's basically my belief that these are tools that can be used and will be used effectively so long as we understand what the limitations of that technology are.
I would echo that and add on that, really thinking from a strategic perspective, how the additional roles and responsibility, additional staffing and compliance responsibilities marry into that technology, thinking through how the exceptions and the path that's going to, how are you going to accommodate those bumps from an organizational perspective as you make those good faith efforts to continue to apply a technology to really satisfy those obligations brought up by the rule.
Ken?
Yeah, in terms of best practices and lessons learned, I think I'll oversimplify it in addition to everything else that was mentioned before. It's really to stay focused on who the ultimate beneficiary of whatever services or products that you are selling or recommending. It's really for the retail customer, and I would argue for any client or customer, it's really for their benefit. Nobody's expecting the professionals to work for free, but certainly in terms of the conflicts and the fees and the disclosures, all of that has to be pinpoint so that the ultimate beneficiary here understands what they're getting into and what your incentives are to make those recommendations.
All right, well, we have time for some questions. It looks like we have one in the back there.
Yes, this question is for the entire panel. Do you have any specific technological tools, software, et cetera, that you would feel comfortable recommending to this group?
Let me take a run at that first. The short answer is no. Much like in the AI space or the compliance space, there are many vendors out there who purport to do various things or the other. Some of them are not complete solutions, and in my view, many of them demonstrate sort of the appreciation of the complexities of the situation, not just from a product selection or one view or the other, but also with regards to the compliance obligations. Many of the developments that I'm seeing is essentially in-house attempts with some vendor-supplied pieces to it, but I have not seen a comprehensive suite, if you will, that will address all of the concerns here.
I would echo Ken's remarks and really thinking for your organization, how you want to prioritize getting these pieces together and having those essential conversations, where you're going to make your again, strategic investments to start to piece together the parts required, both, again, compliance, collecting information from customers, really overseeing your financial advisory space. I haven't really seen a clean solution that does all of those pieces.
Yeah, resist the temptation for a one-size-fits-all, non-tailored solution here, because it's fraught with pitfalls, in my view.
Yeah, what these guys said. I mean, my firm's business is in creating a RIA software in financial institutions, and the degree of customization and configurability based even on the investment advisors specific to each of their businesses is pretty complicated. We spend a lot of time trying to figure out exactly how the different component parts will fit together, how we'll manage and who will be responsible for oversight, delivering of the advice, et cetera. So my expectation is that there are not any one-size-fits-all tools available. There are lots of component parts. There may be some software solutions that get you pretty close, but understanding what the gaps are in those solutions and or the connections between different solutions is really hard.
Yeah, I'll also point out, you didn't ask this question, but I'll make the point nevertheless. Very often, compliance and supervisory personnel are ill-equipped, in my view, or under-equipped to evaluate the effectiveness of some of these tools. So my recommendation as a best practice, back to your point, is to make sure that we're getting the right people at the table when we evaluate those solutions, and I'm including the end, sort of the end users at the firm very early on in the process, in addition to the technologists that may reside at the firm as well.
Absolutely.
All right. Well, please join me in thanking our panelists. Thank you very much.
Thank you very much.
Thank you.